What's up, guys? Today we're going to be talking about the 7 ways the governments affect the pricing and the value of real estate. Number 1, the legislation. Governments can pass or change bills, and what happens here is that the rules of the game are pretty much changed. Just like Bill 197, the one I put out the video for last time, that made sure that the development costs were increased, right? So just like that, the government can say something like, "Oh, well, hey Bob, I think that you shouldn't be owning any more land rights for your property. Instead, you should have no land rights. The only thing that you can own is the property that's sitting on top of the land." Well, that doesn't seem quite fair. Well, that sucks. Let's say for that example, Bob had a bunch of gold underneath his lot, right? He didn't know that it was out there, but he was thinking one day, you know what? I want to go shovel. I want to see what I can find under there. And if Bob sees that there's a bunch of gold that's out there and he wants to go digging and mining for it, he's technically not the owner of anything that's found underneath that land, right? Because the government has now changed the rules, saying that, they might have passed a bill that said you aren't Bill 192. That might say something like, you aren't the owner of anything that's past 1 meter below your property in the ground. Or you are not the owner of anything that's 10 meters above your property, going infinitely up into the sky. So that means that on the 11th meter, 12th, 13th, 14th meter, a building can be put up and they can have whatever they want to have above that. Those are called your air rights. So your air rights and your land rights, they can be taken away from you. You have no control over that. And what happens there is that if that piece of land had a bunch of soil that was very attractive in terms of price point, if it had any sort of minerals, if it had any sort of development capacity going up into the sky, that was very, very attractive to developers. As soon as that power is taken away from the developers or from the owners by the government, because the government says you can't use this anymore or this isn't your right to change anymore, then that ultimately reduces the price point and the value associated with that asset. Right? Because now its maximum use or its maximum value that it can provide you is no more. Another way legislation can work in the buyer's favor is something like the 10-day cooling off period. Here with the 10-day cooling off period, whenever you purchase a condo or a pre-construction condo, townhouse, either of those two, this doesn't work with any sort of freehold assets, only condo type assets. So if you ever purchase anything like that, you usually get something that's called a 10-day cooling off period. In the early 2000s, when a lot of purchases were taking place, people were making impulsive decisions, right, in order to make these purchases happen. And what happened there was, if the developer ever defaulted, the person's deposit was gone, and that was maybe $10,000, $20,000, $30,000 that was just wasted because the developer had filed for bankruptcy and they said, we can't pay this back anymore. So because of that, the government now states that you have a 10-day legal cooling off period in which sort of timeline you can make a decision that if you made a rushed decision when you originally purchased the property, that is not a problem anymore. You can always back out, you get your deposit back, no harm, no foul. On the 11th day, the deal is firm, you can't back out anymore, and now you're pretty much in the deal until it closes. Number 2, taxes. Obviously, everybody should have known about this because it's their main source of revenue, but there's 3 segments in terms of the taxation that takes place, and we're gonna go over them. Number 1 is benefits. When you get tax benefits or tax breaks, you end up seeing a lot of demand that comes in for these types of assets, especially if it's something on the lower end. Usually these tax breaks are given to stuff that is less than $500,000. In Ontario, you can use the first-time homebuyers plan in order to purchase an asset and end up getting a tax break, right? So the tax break comes in the form of a subsidy. The subsidy pretty much states that if you end up purchasing a pre-construction project, you can get anywhere between 5 to 10% of the purchase price in order to help you with your down payment if it looks like you're marginally or not going to be able to make it without that. Number 2 is if you pick up a resale property as a first-time purchase, the government will help you with providing you up to 5% on your down payment. Just like pre-construction where it goes from 5 to 10%, here you get 5% of the resale value. So this helps a lot of people get into the sub $480,000 level because this program is to help people up to that price point. After that, you don't really have that sort of benefit. And this is a good thing because it allows for a lot of people to enter the market, in which case they weren't able to do before. right? So a second way taxation is used by the government is to deter people from buying. Right, so the way to deter people from buying is by increasing the taxation or increasing other costs associated with the purchase in order to stop mass purchasing from taking place. This is something that the Canadian market had seen in 2017, where we had a lot of foreign Chinese buyers come into the market and they were just buying up everything everywhere that they could find it, which is not a bad thing if you were an owner, but unfortunately if you were a buyer, that ended up pretty much adding a pump to the market, which wouldn't have come otherwise. Instead of having a nice slope, now you had sort of a parabolic movement up. So what happened was that the government introduced something called the foreign buyer's tax. So this pretty much meant that if you were a foreign buyer, you had to pay a foreign buyer tax of 15% at closing. Plus, what they asked for was a 35% down payment instead of the conventional 20% down. Right, so having a 35% down plus 15% going to taxes ends up becoming fairly expensive as a purchase price. So this deterred quite a few people at the end of 2018, 2019. That's where a lot of Chinese buyers actually got squeezed out a little bit. And the third one, of course, is income tax rates. The higher the income tax, the less usable cash you have in your pocket to invest into real estate. This goes the same way for corporations as it goes for personal income tax brackets. Now, the third way the government can affect it is through the banking system. The government uses monetary and fiscal policies in order to change how much cash is flowing in the system. So these types of money supply changes usually take effect with changes in qualitative and quantitative easing and tightening of policies and money supply. What that pretty much means is that if the government wanted to pump some more money in the economy, a very common form of doing that is by purchasing bonds. When you purchase bonds in the market, a lot of that money that the government purchases, those bonds, that money goes right back into the banks. When the banks have all this new cash that they're sitting on, they want to have that money circulating in the market and as loans, as credit cards, as whatever you want, not just sitting in the bank doing nothing. So what they'll do is they'll end up having a lot of this money injected into the market by either running promotions on short-term interest rates, but more so the bank interest rate is reduced by the Canadian government. When they want to have cheaper money float in the system, they want to have more attraction take place. That's what we saw in 2020. We had multiple cuts of interest rates, and this allowed for the banks to provide multiple lower interest rates towards the people. So this ultimately means cheaper money. Right? More purchases, cheaper money, that helps the system move around, go forward. And this also creates for adding inflation as well. Now what happens here is that if you have a lot of people buying these assets because money's so cheap, you have a lot of people bidding on similar properties because now they can afford to. And then what happens there is that property values go up because you have so much more competition that at the end of the day, just like we're seeing in today's market, if you have a lot of purchasers, you have a lot of people bidding up the pricing, then you have a lot of higher priced product at the end of the day. Number 4, zoning. So zoning is fairly simple, fairly straightforward. If the government pretty much restricts a piece of land, which is, straight vacant land, it's not developable, and they change that to a zoning for residential complexes or a zoning for apartment complexes, that is going to raise that land's value from, let's say, for example, $1 million all the way up to 10, 20, 15 million, depending on the upside of the sale on these products. But if, for example, the government doesn't want to provide a certain minor variance, or they don't want to provide any sort of changes in the land because it might be part of the green belt that the current party in power really doesn't want to change, then that value there's more or less nothing happens with it. If anything, because it's just sitting there doing nothing, it's costing you more property taxes than anything. It'll probably end up reducing the value later on anyway. Number 5, restricting financial institutions. So restricting financial institutions isn't really something that's common here in Canada. It's more so taking place in Finland, Japan, Sweden, Mexico, stuff like that. Because what happened there was that they had multiple crises. These sorts of crises were due to the fact that financial institutions like banks had a lot of influence in helping the purchasers buy a lot of assets in the market, them as well. So with their mortgage-backed securities, they had a lot of interest in terms of the debt on these properties. They wanted to purchase a lot of these assets themselves. They wanted to have a lot of their clients purchase these assets. They wanted to repackage these mortgages and sell them off to different banks and governments. So what happened was that because they wanted to have a lot of profit quickly, it obviously got out of hand. Everyone is having a party just like they did in 2008, 2007. And so the same thing happened in the US throughout these other countries as well. So what happened was that the government intervened and they said, we can't really have this risk taken on anymore. So we're going to stop this intervention of these banks coming to the market and purchasing a lot of assets very quickly. How they did that was through government policies and rules and regulations. And haven't really seen that same sort of explosion in real estate assets ever since. Now what happens there is that because you don't have overinflated assets, you don't have stuff that is artificially created at a higher level. Now you're having properties that are coming back down in price points and then stagnating for a little bit until, of course, demand always picks up again when you have enough populace entering a certain area. Until then, the prices usually stagnate or grow at 1%, 2% fairly slowly. Number 6, licenses and procedures. So when you look at the process of purchasing a property, it usually doesn't really take that long. You put in an offer, you get the offer result back, and if it's a yes, you close whatever the date is and you move forward. In Ontario, the average time to close would be anywhere between 1 to 2 days. You can have a 1-day closing date, that property is registered in your name and you're ready to move in. Right? So in certain cities like New York, it'll take roughly 12 days to make that close happen. And in certain places like Germany, you have to wait 95 days to close a property, which is far too long. Especially if your money is just sitting there for 3 months, what are you really planning to do? Germany is one of the very few countries in the first world that have a very low owner-occupied rate. What that pretty much means is that a lot of people are tending to go more towards renting an asset rather than purchasing an asset themselves. I mean, if you're going to be waiting 3 months to close on a property, your money can be doing so much more elsewhere. And I know a lot of people might not be thinking very far down the line, but when you're making a purchase like that, a 3-month wait time really makes you second guess if you actually want to put your money in an asset to sit there and wait along with the market, especially if less than half the people own it, or should you put your money elsewhere, right? So that has a lot to do with the timing. If you're waiting a day to close in, the rush is still there, the excitement is still there, and you can move on. But if you wait 3 months, that's a different story. Now, number 7, the thing I dread, the thing I very much dislike, is called rent control. This, from an investor's point of view, is probably the worst thing that was ever created. Because what this pretty much means is that the government locks in a certain percentage point that you can grow your rent on per year. Which, look, I know it's hard for people to rent or purchase places. I understand that. So let's use California, for example. California has a rent control of 5% per year. I believe there's a cost of living there that's associated with that 5% as well. So what that pretty much means that if you wanted to increase your rent rate for your tenant, you couldn't increase it past 5%. Now, that doesn't matter if you put in $250,000 worth of renovations in the property or $10 worth of renovations in the property. If you want to see your value add take place in an asset, you wouldn't really see that out there unless, of course, you had the whole property vacated and then had the new renovations come in, then you rent it out to all these new people. But even then, at that point, you're gonna be waiting so long that just getting the people out of the property, because it's a majority tenant state property, you're gonna have a problem there because it'll just waste so much time, so much money, so it just isn't really worth it. Same thing in Canada. You don't really have a rent control situation here, but on the same vein, you do have we are a tenant province, so you have a lot of people supporting the tenants and not the landlords. And if you're looking at something like this as an investment point of view, you can't really kick somebody out as you could in Texas in like a week. You can't really do that here, so it ends up becoming a little tougher for investors to pick and choose which locations to go to. More so, they go to the locations that end up having landlord benefits. So if you were investing, look towards areas that don't have any sort of rent control and they are landlord friendly, so you can end up having your investment work for you much faster, and the tax rates are generally more affordable, more attractive there. Now with rent control, the way this affects asset prices is that if the government puts on rent control, a lot of investors take their money out because it's not a very attractive thing to do. If you don't have any rent control and you don't have much of taxation, nor do you have a lot of rules and regulations for the landlord as opposed to the tenant, a lot of assets are going to be increasing in value, especially rental capacity assets, and landlords and investors are going to be rushing in. So these are the 7 things that the government uses in order to change and affect asset prices. If you have any questions, you can just leave comments below, email me, text me, call me, whatever you like. And just let me know what you'd like to see on the next time. Thank you. Take care.